Viewers will be taking a concept of relevant costing and will use ICAN May 2018 question 3B to throw more light to the concept of relevant costing. You will help us break the question, then we'll profile solution based on the requirement of the question.
Diban Construction Limited is deciding whether or not to proceed with a one-off special contract for which it would receive a one-off payment of 2 million naira. Details of relevant costs are: 1. The special contract requires 2,000 hours of labor at 600 naira per hour. Employees possessing the necessary skills are already employed by Diban Construction Limited but are currently idle due to a recent downturn in business. Material X and Y will be used. 100 tons of material X will be needed and sufficient quantity of material X is in inventory as the materials is in common use by the company. Original cost of material X in inventory was 1,500 per ton, but it would cost 1,800 naira per ton to replace if used on this contract. Material Y is in inventory as a result of previous overpurchasing. The original cost of material Y was 500,000 naira, but it has no other use. Material Y is toxic, and if not used in this contract, Diban Construction Limited must pay 240,000 naira to have it disposed. 3. The contract will require the use of a storage unit for 3 months. The company has recently leased the unit for 1 year at a rental of 80,000 naira per month. The unit is not in use at present. However, a neighboring business has recently approached Diban Construction Limited, offering to rent the units from them for 110,000 per month, and overheads are absorbed at 750 naira per labor hour, which consists of 500 naira for fixed overhead and 250 for variable overhead. Total fixed overheads are not expected to increase as a result of the contract. A trainee accountant has performed the following calculation, which shows that the contract will cost 3,590,000 naira to deliver, and concluded that the contract should therefore not be accepted for 2 million naira. Relevant costs: description: labor 2,000 hours at 600 naira amounting to 1,200,000. Material X 100 tools times 1,500, which will give us 150,000. Material Y original cost 500,000. Storage 3 months at 80,000 naira 240,000. Overheads 750 at 2,000 1,500,000. Total 3,590,000. Required: calculate the relevant cost of the contract and advise whether the contract should be accepted or not on financial grounds.
Okay, we'll profile a solution to the question we have gotten here. As was read, we'll take each of the informations one after the other, analyze the informations, and give our reasons for selecting some costs and for declining some of the costs that was used by the trainee accountant. First, you have to know that relevant cost considers cost of items that would increase based on either the acceptance of the contract or not. So that cost that will increase as a result of the acceptance of the contract is what will be accepted. Relevant cost also helps us know that we cannot accept or record some costs because they are past or historical costs. We will not regard them. We will not regard cost that does not change. So we'll be looking through the informations we have been given here. We'll fish out those costs that would leave out and put in the needed cost, which brought about the term relevant cost. As the question read, Global Construction Limited is deciding whether or not to proceed with a one-off special contract for which it would receive a one-off payment of 2 million naira. Details of relevant costs are, say I, The special contract requires 2,000 hours of labor at 600 naira per hour. Employees processing the necessary skills are already employed by Durban Construction Limited but are currently idle due to a recent downturn in business. Now, those laborers have been paid already and are idle. So, if I am to engage them into this contract, I am not going to pay them overtime. I'm not going to pay them additional costs. I've already paid them and they are idle. They have not worked. So I can use them for the contract and I will not incur any cost for using them for the contract. So the labor costs will be nil. There will be no value for labor costs since they have been employed and paid, but they are idle currently. So labor cost will be nil since they are currently idle, and using them for the contract, I will not have to pay them additional money for usage. I will not incur additional costs for using them for the contract. Now, II says materials X and Y will be used. 100 tons of material X will be needed, and sufficient quantity of material S is in inventory as material S is in common use by the company. Original cost of material S in inventory was 1.5 per ton, but it would cost 1.8 per ton to replace it. So you are seeing it there. Original cost initially, what we bought that material S was for 1.5. Now, if I want to replace it, since that material S is always in use, it's always being used, if I should use it for the contract, it would mean me replacing those materials. So if I want to replace them now, I will have to look or consider the replacement cost, not the initial cost I use in buying it. Because if I should go to the market now, the current amount will be 1.8, which I use in replacing it. So I will consider 100 tons, that is for material X. I will consider material X, that is 100 tons. 100 tons times the amount to replace it is 1.8. That is our replacement cost. That is what will be looked at. So 100 times 1.8 will give us
180,000.
180,000. Now, going further, we equally have material Y here. They went further to tell us that the original cost of material Y was 500,000, but it has no other use. Material Y is toxic, and if not used in this contract, Durban Construction Limited must pay 240,000 to have it disposed. That is, the material Y is not being used for any other thing. It's like a dump, and they have told us clearly that it's toxic in nature. If I don't use it for this contract, I will have to dispose it at the cost of 240,000. So using it for this contract will save us that cost of 240,000 that we would have incurred in disposing the material Y. So for material Y, I'll be having cost savings. The amount I was supposed to use in disposing it is 240,000. Abi, 240 is the amount I would have used in. So this will be in brackets since it's cost savings, so it will not add up to other costs that we have here. So the third point here, they say the contract will require the use of a storage unit for 3 months. The company has recently leased the unit for 1 year at a rental of 80,000 per month. The unit is not in use at present. However, a neighboring business has recently approached Durban Construction Limited offering to rent the unit from them for 110,000 per month. Now, the 80,000 is considered a sunk cost based on what I've told you is a historical cost, and it will not be relevant in this scenario. It's sunk cost, it's a past cost. Now, the present offer we are receiving is 110,000 for the next 3 months. If we are to use that space or that storage space for the contract, we will have an opportunity cost of that 110,000 times 3 months. So we have to consider the opportunity cost, that amount we are going to lose if we are to use that space for the contract. So storage space, I'll say, let's say the amount per month is 110,000 and it is for 3 months times 3. So I'll call this opportunity cost. Opportunity cost. So this is the opportunity cost I will incur if I should use this storage space for contract instead of the offer we have gotten now. So I will include it in my cost. 110,000 times 3 will give us
330,000.
330,000. Now this is for storage space, or we can say rental space. Then the next point here, they says overheads are absorbed at 750 naira per labor hour, which consists of 500 naira for fixed overhead and 250 naira for variable overhead. Total fixed overheads are not expected to increase as a result of the contract. Then they went further to say a trainee, okay, those informations are for what the trainee prepared. Now they are telling us that the fixed cost will not change as a result of the contract. So if you recall what we said at the beginning, we said any cost that would not change as a result of the contract will not be considered. So we're only considering those costs that will change as a result of accepting the contract. So I will only consider, for the overhead, I will only consider the variable cost. I will not consider the fixed cost since it will not change as a result of the contract. So overheads, I will consider the variable cost. The variable cost to say is 250 times, we have 2,000 hours. So 250 times 2,000 hours will give us what?
500,000.
500,000. Now, this is the total cost we have, which you can see is different from what the trainee have prepared. We have to total this 180,000 less 240, add 330,000 and add 500,000. We'll be having the total of what? 770,000. Now this is the total cost we incur. Now considering the fact that they are offering us 2 million naira for the one-off contract, we'll have to compare and see. So we'll be getting our incremental profit, because you can clearly see the profit is greater than the cost. Incremental profit, which is the amount offered, 2 million less the cost of 770,000. It gives us how much?
1,230,000.
1,230,000. Now this is the incremental profit. Considering the fact that we have an additional profit of 1,230,000, considering the cost we are going to incur in accepting the contract, we will advise Duban Construction, is it Duban Construction or Duban Construction Limited, to accept the contract. So is it Duban? D-E-B-A-N. Duban Construction Company should accept the contract since the benefit is greater than the cost incurred for the contract. So the bank construction company should accept the contract since the benefit is greater than the cost incurred for the contract, which is what we have done here. Thank you very much for your time, and I hope this video will be useful to you in your preparation for the forthcoming ICAN examinations. Thank you.